Anyway,
No
thank you,
worries.
everyone, for joining today's DCREC webinar on the new DOL proposed rule. We have Kevin Walsh and David Levine from Groom Law Group who are going to lead the session today. So, Kevin and David, without further ado, you guys can take it away.
Yeah, thanks, John, and thanks DCREC for hosting this webinar. Everyone knows, in the last few weeks, the Department of Labor released a new proposed rule, fiduciary duties in selecting designated investment alternatives. This follows on the White House's executive order from last year seeking to democratize access to alternatives. This is probably the biggest breakthrough in terms of placing alternatives on a level playing field with more traditional assets than we've seen. I don't want to say in my lifetime, but definitely in my lifetime in the defined contribution space. So today we're going to break this apart into a couple sections. First, we're going to share some initial thoughts, initial reactions that we've had, that we've heard from folks, so folks have a view as to what folks are thinking. Second, we're going to provide a very high level summary of the rule. After that, we're going to do another discussion into why this is being done. What are the considerations that led to the administration doing this? And finally, we're going to take a closer look at the safe harbor factors. So with that, David, what have you been hearing on the street, or when you read through this 164-page double-spaced proposal? What are the initial reactions?
Well, I immediately read the Cliff Notes is the where I like to begin, Kevin. But after reading hurriedly on that Monday morning through everything and having read it many times since, I think the response initially has been positive. That's the way I take it. Right? Yes. Are there little things in the proposal that people say could be enhanced, clarified, improved in some ways? Yes. But people like this approach. We know that this is an area, as you know, you and I spend so much time talking about this. We know this, that some people in the industry are like, this is great. Some people are like, I'm not sure I like this. There's never unanimity in where people go, but people are very happy with this. It does not say, as some people thought it might say, you must use alts. It does not say that. This is a rule, and I think that's something that gets missed very easily, because we've all seen editorials in favor, we've all seen editorials that are against, that have been showing up in the newspapers already. The key is, this is a rule that's more about what does a fiduciary process look like, and people like that where it says there are opportunities here. If you do A, B, and C, this can give you a safe harbor against litigation. Is it a guaranteed slam dunk? No. But people really like the idea that instead of it just being, if you are prudent, you are prudent, which is the way a lot of other safe harbors have worked, that there's some real meat on the bones here and gives a path. Clarifying, tweaking, revising, certainly on the table, but that's it. And I think the key here is, everybody I talk to, it's not just saying no. People are like, okay, how do we work with this and take it to the next step? So that is the starting point, I think, is the way people are reacting. And we can go by different segment, because obviously we're here with DCREC. Product creators, I think, are very positive on it. Plan sponsors are getting their arms around it. The intermediaries, like consultants and advisors, each of them have different views. There are some that are very pro alternatives and some not. But underneath it all, even for intermediaries, there's a lot of good in here. And I think as folks dig in, the feedback I get is this can be really helpful to me and or my clients. So something to think about.
Yeah, David, thanks for that. I mean, when I've looked at it, what I've heard is there was a lot of initial surprise as to what the package looked like. There had been a lot of discussion prior to the rule coming out that we were going to have, a 10 commandment style rule that said, thou shalt include private equity, thou shalt include private real estate, thou shalt include crypto. And even if you look at some of the initial reactions, it's pretty clear that some were written before the rule was released, where they say, this is awful. I can't believe the Trump administration is saying 401k plans have to include private credit. The more measured approach when folks have looked at it is, this is all about process. This is a rule that's designed to put folks to sleep. It's not designed to identify, sexy asset classes. It's designed to put all asset classes on a level playing field and say, if you're a fiduciary and you follow a prudent process, you ought to get deference. And so, some of this is the reaction I've seen is the department being clear enough or too vague? And that's kind of folks probably have heard this before, but it's a bit of a Goldilocks situation where, most folks I've talked to have said DOL did a great job at providing a framework and giving examples that allow for folks some flexibility in their process. But there are some who say, the process ought to be more prescriptive. We'd much rather have 300 boxes to check. On the other side, there's some who say, just give us the 6 factors and we can figure it out from there. So, David, I've been hearing similar things to you. Folks are in the asset management industry are broadly supportive. When we look outside that, the plan sponsor community, I do think they're generally supportive, but still trying to, get their hands wrapped around different aspects of it.
And by the way, looking at some of the attendees that we have with us today, I think it's very, very interesting, because I think for those of you who are with us today who are the intermediaries, and I did see some of you attending in that group, you have a key role here. You don't need to say it's definitively right or definitively wrong. But in an era where people say, well, that's commoditized or not, your value and insight here is incredibly valuable. And I think that's something to really keep in mind. Sorry,
Yeah.
Kevin.
Yeah, so just jumping in a little bit, kind of the TLDR for the rule essentially is that the department has restated or has come up with a framework for how fiduciaries can have a prudent process. In doing so, the department identified 6 factors and said, if you consider these 6 factors, you document it, you act reasonably and thoroughly with respect to them, then you ought not be second guessed by courts when you make an investment decision. At least on the basis of acting prudently. If you act disloyally, if you violate the prohibited transaction rules, that's something different. But in terms of alleging that you acted in prudence, DOL is saying, courts, if folks consider these 6 factors, you should defer to their judgment that it was a prudent process. The 6 factors that a fiduciary should consider: its performance, its fees, its liquidity, its valuation, its benchmarks, and its complexity. None of these are shocking factors. None of these are words that we haven't heard before. And we'll take a deeper dive into what each of those 6 mean. But David, I think folks are interested in the background of why this rule came to be. And do you want to set the table a little bit with just what the executive order said, and then we can talk a little bit about the litigation, durability, and practicality considerations?
Absolutely. Happy to jump into that, Kevin. And for those of us who are joining us, Kevin and I have a framework today, as was by the agenda, but we thought we'd make this a little more conversational, so we appreciate you joining us. I think the background on this is there has been a real interest in certain segments of the retirement industry in expanding the investments that are available out there beyond just your publicly traded securities. And I'll sound like a little bit of research talking points here, but over the past decade, the number of publicly traded securities has dropped, and there's been a huge rise in other investment vehicles, interest in lifetime income, and just simply the fact that a lot of companies are now private, especially with private equity holding them. There's things like private credit, so the debt is different, and we know that there are different news headlines at different times. But the key is we've seen a diversification of investments. And ERISA is really about diversification of investments. You leverage into that litigation, and Kevin's going to go more into this in a minute, so I won't go too detailed on it, has really risen. So President Trump in August of last year put out an executive order directing the Department of Labor and the SEC on things like accredited investor, some items here. But the big focus right now is on the Department of Labor to put out guidance and including a safe harbor supporting the use of alternatives in defined contribution plans. It doesn't say you put out a rule that you must do it. It just says put out proposals to effectively level the playing field. Asset class neutrality is kind of what derived from this. That's the term we use a lot of. And in addition, while you're at it, given the litigation wave, please address it. So the department went back, and there were different stakeholders. And as Kevin pointed out a couple minutes ago, there was expectations of the rule would be here, and it was actually over here instead, moved over a little bit. But what the department did is really try to create sort of the not too hot, not too cold, right, just right rule that addressed the executive order, but also provides a framework for a bigger area. But that's why we are here. The department was directed in an executive order to move the ball forward. And then we get the rule. And Kevin, does it make sense? Maybe you talk about a couple of the, maybe you start off by talking about litigation and some of the high level impacts.
Yeah. So, the president said to DOL, make it easier for folks to consider alternative investments. And DOL turned around and said, President, we got this, but we're going to go further. We need to come up with a framework for all investments because litigation is really the threat for fiduciaries when they're making decisions. And so, DOL comes out at the beginning of the proposal and they say the overarching goal of the proposed regulation is to alleviate litigation risk that interferes with the ability of American workers to achieve the competitive returns and asset diversification necessary to secure a dignified and comfortable retirement. So boom, DOL comes out and says it. Litigation is the number one issue that they're trying to address with this proposal. They march through why they feel that way. They note that since 2016, half of all plans with $1 billion more in assets have been targeted by at least one lawsuit. They then referenced surveys, in a survey, and I think the 71% who said they haven't done this may have been a little bit cagey in their answers. But in a survey DOL points to, 29% of respondents said that they had decided against offering services or investment options because they perceived those options as making them more vulnerable to litigation. So, survey respondents to DOL have said, we're not offering the best lineup because we're worried about being sued. Now, how can DOL address that? DOL recognizes that the motion to dismiss is the ballgame. They point out that prevailing on a motion to dismiss, generally less than $2 million in legal costs. Once you get past the motion to dismiss, you get into discovery. That gets expensive. And so even if you're found to be prudent, or ultimately if you're found by a court to have acted prudently, it still feels like a loss if you're telling your company's CFO, look, we won, but just FYI, we have $10 million in legal spend. So DOL is trying to, through this rulemaking, address that. And what DOL comes out and says essentially is that plaintiffs bear the burden of proof and persuasion on all the elements of their claim, and that if a defendant complies with the safe harbor factors, and this is DOL's language here, the fiduciary should be confident that it's fulfilled its fiduciary duty of prudence. And that if you can affirmatively show that you've complied with this, then you should be able to defend your action successfully. Now, a couple things here, and this is an open question here, and this is something where DOL has said we want to be helpful, we want to solve the motion to dismiss. They've walked through this in the preamble. Motion to dismiss is the ballgame. Folks are digging in a little bit, and I think in the final rule we'll want some more clarity here around, if I have to successfully show that I have complied with the safe harbor, is that something that I can do at a motion to dismiss? Or is the safe harbor actually going to be more useful later in a trial, like at summary judgment, in which case, the amount of money this saves me, the amount of challenges this deters, may be less than what the department's hoping. So David, do you have any comments on litigation, or do you want to pivot to durability?
No, I think you said it really, really well. I think it's the important thing to keep in mind here, and I think you said it well. It's not clear exactly where it will land, but it's a good effort to try to minimize the I'll say less meritorious claims at this point. There's a lot of plaintiffs' attorneys who've already been quoted in the media saying, well, this rule means nothing, and here's why. And I think part of it is that, and Kevin and I have spent a lot of time on this, is part of it is just the deference that the Department of Labor and other folks get for their guidance has been lessened in recent years. And as a result...
Yeah, David, but we got no attendees for our 45-minute webinar on, new standards of deference for agencies and Skidmore versus Firestone. That was not popular.
I was not even going to say the name, Kevin. You're the one who went wonky. But anyway, the key takeaway is the plaintiffs are thinking, that's nice, but we can move forward. That's the too long didn't read version of it. But let's talk about durability, the next concept here for a moment. The durability, for any of you who've ever looked at ESG investing, environmental, social, and governance investing, you have seen that back to the Clinton administration in the 90s, there's been a yo-yo. One administration, often more Democratic, is more pro-ESG. Republican administrations are not as in favor of ESG. And through the changing of the political tides, we've had back and forth. What does that mean for plan sponsors? Plan sponsors are like, you know what? We don't want to be in this whipsaw. and they stay away from it mainly. I'm not here to tell you whether ESG is good or bad. That's not the topic today. Instead, the Department of Labor, in writing this rule, is effectively trying to get ahead of that in a few ways. First, the Department of Labor is framing its rule as saying, our rule that we've come up with is consistent with the law that's already out there, the case law. We as lawyers defend a lot of these lawsuits. And when we've defended them, there is some really good authority out there. And they're saying this is taking what was decided by the courts and anchoring it in regulatory guidance to make it even stronger for the defendants, which should give folks confidence as they go forward. Inevitably, the plaintiffs will try to push back on this, but that is a design that I think is very well put out there to really try to make this anchored. Because by creating this rule also, that's not just picking winners and losers between alternatives versus large cap equity, bonds, and other types of items. And the reason why that's good is the Department of Labor has framed a rule. Yes, it talks about alternatives, but it's designed to create a process which can be used across investments and doesn't direct you into one or another at this point. And that really is so that if a court reviews it, it doesn't look like this is the DOL making it up. The DOL trying to be consistent, and they cite back way in time, and I won't get into the wonky like Supreme Court type of things at this point. But the Department of Labor is going back to the so-called plain text of the rules, so as to make it so they say, what we have done is anchored in the law, what's been done, and just the text itself. And it focuses in onto neutrality and asset class neutrality. Those concepts here are designed to anchor the rule so it remains consistent. And even if there's a future administration, it's designed to set a baseline that will be there and try to make it so that it has weight and persuasive weight where the courts can actually say, yes. And even notwithstanding the fact we're not doing our 45-minute deference webinar that Kevin was referring to, I don't even think I would attend that one. But given that, I think it's designed to give something so the courts can say we should listen. And that's kind of the idea behind it. Kevin, you want to talk about practicality for a minute?
Yeah, so I think the other aspect of this proposal is the department was trying to be practical. Agencies frequently are staffed with folks who've been in government their whole lives instead of being in the private sector. And so you sometimes end up with rules that are the compliance costs outweigh the ability of anyone to comply. And here, what the department has done is they have tried to use 6 principles that they think that plan fiduciaries should follow. And then they've provided 20 examples so that fiduciaries have ideas for how the Department of Labor believes those principles should be applied. And essentially what they're trying to do is provide clear guidance without being overly prescriptive. DOL uses a unique phrase here, which is maximum discretion and flexibility. So what DOL appears to be trying to do is it appears to be trying to tell plan fiduciaries, use a prudent process, make the best decisions you can, and evaluate all asset classes using a neutral framework. If it works for your plan, don't not use it because you think somehow that DOL has a thumb on the scale. And so, the proposal is grounded really in trying to eliminate litigation risk to the extent DOL can, trying to frame this as consistent with ERISA's history and the statute so that it's durable going forward. And then also being practical so that plan sponsors, plan fiduciaries, consultants, and OCIOs are able to implement it in a way where they can have comfort that they've implemented it. So, with that, I think we should pivot to the 6 factors. So, David, do you want to take performance? Take that first factor.
I'll happily take performance. So clearly, as Kevin said, performance is key. No matter what, even before this guidance came out, everybody recognized that performance was an essential item. The Department of Labor has put their rule out with a basic principle. You need a similar number of investment alternatives, and that you look at the risk-adjusted expected returns of the option, and then you take in mind the expected time horizon and trying to say, does that work for your participants and beneficiaries? This standard does not say you must have one specific discussion on exactly how performance works. That is not what is going on here. Instead, it's designed to give a flexible framework for that if a fiduciary even just engages in this process should help you with the safe harbor, because the safe harbor, the DOL says you don't have to do all the safe harbor characteristics, but each of these on their own can be helpful and beneficial to you. And a couple things to keep in mind. It's not just about actual absolute returns. We all know that there are periods of time where if you just invest in the S&P 500, you're going to outperform virtually everything. Taken even to more extreme, if you are perfect at knowing who the top 5 tech stocks will be in the next year, and you picked like some of the ETFs in that space, and you went heavy on those, that could be a benchmark that you can never match unless you're just always going to be chasing. And that's part of the challenge that we have to deal with here. So the DOL points out importantly that it's not only about expected returns, but it's also about the risks of the investment alternative. How does it work in the market? The upside, the downside capture, which is essential because a lot of the plaintiffs' attorneys have actually been bringing suits saying, well, this target date fund isn't good because 4 others did better. But if one fund is designed to protect you on downside risk and another one is designed to be triple levered, they're really not apples to apples. And that's something to really keep in mind as we go forward. So the Department of Labor gets into that. And the net of fees and expenses is a huge item that I know Kevin and I have been really focused on over the years. Because so often people say different solutions are expensive, like private real estate may have costs. That's okay. Why? Because it's net of fees and expenses. And this dovetails back finally, to hand it back to you in a second, Kevin, to one of the things the DOL kind of hits over and over, and I hinted at it before. The DOL recognizes planned fiduciaries may do this themselves, but they will often look at 321, 338s, investment managers, or just investment advice fiduciaries in English to help them. And a lot of these items can be areas where advisors and intermediaries can add great value in documenting the process and the why. So whether you are a product manufacturer talking to the intermediaries, or you're a plan sponsor who has support, which the majority do, or you're one of those folks in the middle who provides that support, there's a lot you can bring to the table in this area. Kevin, do you want to talk about fees?
Yeah, I mean, I think the key, though, I said one thing about performance, which is, the department does have examples in here, and I think the examples are pretty useful. They give an example of, including alternative assets, and the reason that you're including alternative assets in the example is to reduce risk, not to increase return. And DOL says a prudent fiduciary is focused on risk-adjusted returns, not the highest growth returns, like you said, David. But it's useful to think that when a fiduciary is making a decision and you're considering new asset classes or looking at the asset classes you include, you're allowed to seek things that are designed to smooth your ride instead of just things that are designed to be bumpy but up and right. Second factor they talk about is fees, and I think folks recognize fees are an important part of the discussion around any investment decision. And the department frames fees, again, around risk-adjusted rate of return. So they say that when you consider similar alternatives, that a fiduciary should determine that the fees are appropriate in light of the risk-adjusted expected returns and any other value that the investment option brings. So it's not that you have to select the lowest fee option. It's not that you should be focusing myopically on fees. It's that in light of the risk-adjusted expected returns and other values, that the fees are reasonable. And then, DOL provides 4 examples in terms of reasonableness of fees, how to think about it. The first example they provide is an investment that includes a lifetime income feature. And the lifetime income feature adds extra fees, but it provides the value of an annuity. And DOL says a prudent fiduciary, if they understand this and they look at this, can determine that it's prudent to include a lifetime income feature inside a DIA. A second example, again, it's similar to that first example in performance. Planned fiduciary adds private equity sleeve to their private equity and hedge fund sleeves to their target date fund, their default investment. Much higher expenses, but when they run the risk and return numbers, the modeling suggests that it's still going to lead to better outcomes. Again, the department says, look, this can be prudent as long as the fiduciary understands it. Third example they give is around active versus passive. They use small caps as the example. And the fiduciary is picking among a number of options. They identify a handful of passive providers. They identify a handful of active providers. They do essentially modeling. They're stochastic. I don't know the word. It's a word I'm really bad at pronouncing. But they
stochastic. You nailed it.
I'm not even going to try again. But they run models for that. And essentially, the plan fiduciary concludes that the higher active fees are justified because they're going to lead to more diversification. And the department says, that can be prudent. And then the last example DOL provides, and it's helpful that they provide negative examples because it helps us understand where the limits are. A plan fiduciary is looking at an investment. Turns out there's an identical lower cost share class with the exact same investments. It's imprudent to pick an identical, more expensive option when there is a lower cost identical option available. So, David, do you have anything you want to provide on fees, or should we move on to liquidity?
Well, I do want to address fees because I actually want to go back, if I could, to a question we got. I just want to squeeze it in right here. We got asked about how can you measure risk-adjusted return. So it goes back to performance, but I thought I'll just dovetail that back into our chat here. Because how can you do it when you're comparing public and private asset classes when you're looking at the volatility? Because public asset classes are valued daily and private ones may be valued quarterly. And the answer to that is there's a number of pieces. First, some folks who are using private solutions are using synthetic NAVs and other things, the way to bring it down, which is going to dovetail right into valuation in a minute after we get through liquidity. But that's number one. Number two, that underneath it all, yes, even though it makes it look like it's more smooth or sort of jerky moving around at the valuation date, that's okay. Because when the DOL is talking, they're taking a look at the long-term performance horizon. One of their examples that they give under performance is about the fiduciary reviewing like the 1, 3, 5, and 10-year data for like a target date series. So we will still have that data. So that is a way to address it. By the way, we do know that we have one other question. When we get to when we get to valuation, which I think is going to come to me, I'll answer that question there as well. But Kevin, maybe you want to pick up again on liquidity a little bit more?
Yeah, I'd be happy to. And so liquidity is the next factor that the Department of Labor focuses on. And with respect to liquidity, the department says, the North Star here is that there should be sufficient liquidity. The fiduciary should believe that there's going to be sufficient liquidity to meet the expected needs of the plan at both the plan and the individual levels. So, two types of liquidity: plan liquidity, participant liquidity. DOL says in the rule itself, there's no requirement that a fiduciary select only fully liquid products. And in fact, a prudent fiduciary process may regularly lead to a decision to sacrifice some plan or individual level liquidity in pursuit of additional risk-adjusted return. Now, here the department provides 5 examples. I'm not going to go into them in quite as much depth, but they are some are pretty informative. The first one of these is participant level liquidity. And here the department suggests that if your plan says your participants can take loans, if your plan says you get hardship withdrawals, that your DIAs, the on-menu options, ought to be designed to do that. Now, how can a fiduciary make sure that they're going to do that? For a mutual fund, DOL says, if you get reps that the investment's complying with the liquidity risk management rule, so 22E4, then rely on those reps. In the preamble, they say, if you invest in a CIT and the CIT gives you reps that it has a liquidity risk management program like the Rule 22E4, then you can rely on that too. That's weird. CITs generally don't have those. They wouldn't have them. It's an SEC requirement for 40 Act funds, but so be it. They also then provide, so that gives you some concern that, well, wait a minute, maybe we are expecting daily liquidity. Maybe we have a 15% liquidity cap. What's going on here? So they provide a second example now with an insurance product. The insurance product, if you don't take your money out in the first 90 days, then you've got to, you get hit with a market value adjustment when you redeem. DOL says, the benefit of this illiquid insurance feature, an annuity in retirement, can outweigh the idea that if you want to get your money out at some point after those first 90 days, you take a haircut. Plan level, then the department talks about, one, do you understand the liquidity that you're getting? And for plan and participant, there's an example at the end which talks about quarterly liquidity for plans where a plan fiduciary can prudently decide that quarterly liquidity is sufficient at the plan level, along with liquidity at the participant level. In the example, they use the 22E4, they use the liquidity risk management program. So David, I think that takes us from liquidity. Do you want to talk a little bit about benchmarks?
Right. I was going to go into valuation, actually.
Much better.
There we go. But at the same time, I'm watching the clock, and I know we right now have maybe about 12 minutes, so I'll try to be quick, and we can hit valuation, benchmark, and complexity, and hopefully round it out. We do have a question about valuation that I'll weave into this as well. So when it comes to valuation, the department's safe harbor basically says that the designated investment alternative has adopted adequate measures for timely and accurate valuation in accordance with plan needs. That's pretty general. But again, the department has given us some really good examples here. And the department basically talks about that, number one, public markets, they recognize that public markets, regularly broadly traded, recognized markets, that's good enough. That's good enough for valuation. And then they also recognize that there should be a process for valuation consistent with, there's the Accounting Standards Board, ASC 520. It's basically a fair value management type of concepts. And that's independent and that is widely used. And it does leave some room, the Department of Labor recognizes, for sometimes a manager like exigent circumstances, for instance, where there could be a situation if there's going to be a downside risk or an impact on someone where things are going to, on other investors, that they can have a proper valuation that's there. So there is flexibility, and that's a key point on this. So as we talk about this on the valuation side, our question was that, well, how does this really work for valuation? The department's in their examples and talks about whether you can look at the mutual fund prospectuses, what's their process, do you think their valuation works if there's privates inside there? And that's, again, where it may be the plan fiduciaries, but it may be the people creating the funds, creating a process guide and tools. We're already talking to people about what do they want to have, how do they build it? Like, we've actually been given real thought about how to build these things. Alternatively, does your intermediary, if you are an investment advisor or consultant, do you actually help people do this? This is a value add in your process. So, for example, if you're the manager, going back to that example before, if the manager thinks a valuation is wrong and they don't want to adversely affect folks, the manager can step in. I know that there's some discussion here, but the key is it's independence. And the question we have is, well, some folks like real estate use outside valuation. Other folks in other types of alternatives don't necessarily use independent valuation experts. How does this all play out? And the key here on this is that underneath it all, it's really about creating a process that works. I know Kevin and we spend a ton of time on product work. And when we've been building products in this exact space, there's a lot of focus on, okay, we can provide some of the inputs, but how do we make it so that we're not setting our own valuation? How do we make it so we're not setting our own fees? The manager always is going to have to give data at this point. But when it comes to actual valuation, for instance, like in a CIT, people are using outside or objective criteria that wire things in. So there's a number of ways to actually build this. And to come back to the examples for a second, because there's three in valuation that the DOL gives us. The third one talks about a different area where there is actually some narrow work. And Kevin, I'm just watching the clock. I know we have until 45 after, so we have about 8 minutes. So I'm going to try to wrap this up soon. The reason why I really focus on valuation here is that there's been a lot in the press in this, so we won't go into the weird world about this. But if a continuation fund where a fund sells to like a second fund, it's not necessarily secondaries, although it gets woven in with secondaries sometimes, and we're hearing that discussion. And can a fiduciary just rely on the manager to set the valuation for a continuation fund buying assets from a prior fund? And the DOL gives a negative example saying this doesn't work because you're worried about mitigating conflicts. And this goes to the question we had submitted to us. It doesn't mean you can't use a continuation fund, but folks are going to have to be working. We've already been doing this for a while and we'll continue to see this, to actually come up with ways to actually, so it doesn't look like I set my own price and value. Because go ahead, Kevin. I know you love talking about this, so go ahead.
I just want to jump in here because the example they use for continuation funds also isn't how continuation funds typically work.
True. So I wholeheartedly agree.
Yeah, the department's focused on independent and conflict-free valuation, and that the fiduciary understands the valuation process. And it's an area where I would expect to see a lot of commentary or changes or thoughts from the community, and also clarification from the department. Because I think we have an example. We have a questioner who came in and said for private real estate, folks tend to have an independent valuation agent. Now, if the manager's picking the valuation agent, arguably that might not be independent conflict-free valuation. On the other hand, we've got private equity managers who are going to be providing info about inputs. And again, they're going to provide inputs, or they're going to pick who their auditor is. There's plenty of service providers they may pick. But again, I think we'll want the department to clarify what independent conflict-free valuation means in this context, because you still have a duty of loyalty apart from your duty of prudence, and it seems kind of like a weird fit. But how continuation funds, it's a weird example because generally the price that the continuation vehicle pays for what they bought from the prior fund is set by a third party buying an interest in that prior fund. So essentially the continuation vehicle gets a Me Too pricing rather than the pricing described in the example. And that's why when people jump to the conclusion that this is saying continuation fund's bad, I look at it and say it's not saying necessarily continuation fund's bad. It's saying understand what the valuation mechanism is, and don't do it in a slapdash way.
And I agree with you, Kevin. I think a lot of this is, and I think we'll see comments on this. I know we will, because we're already getting questions and talking to people about this. We will see comments that ask for clarifications. As we said at the beginning, a lot of people are very positive, but they're asking for clarifications and enhancements. But I know we're running up against our time here. So let me hit one item really quickly on benchmarking at this point. Benchmarking is a very big deal. And I think there's a core item to keep in mind here as we go forward. Benchmarking for purposes of investments is not the same as the fee disclosure notice. The Department of Labor makes that crystal clear. So that means the participant fee disclosure notice, the one you get if you're in a 401k plan, there's a benchmark that comes from DOL guidance, but that's for the participant. But in terms of benchmarking, when you're doing your analytics on deciding, the department actually makes it clear that simply just using like a generic all large cap fund may not be the right answer and can be the wrong answer for like a TDF. That's actually a negative example in the department's actual discussion. The department does make it clear there is not necessarily one correct benchmark. We know in certain segments, everybody says it should be this. And I think the department's saying you should be flexible. It should be representative of your investment. And you can't just say, I'm going to make a benchmark that I'm always going to just crush because there's absolutely no correlation. But it also says there is room in defining your benchmark. And this is a role where product creators, intermediaries, and plan fiduciaries should really work together. It can make a huge difference in litigation about how they work at this point. Similarly, it talks about composite funds, a custom composite fund where you would TDF where you create your composite benchmark for yourself. Or if you're going to have a fund with a private equity sleeve, how you can basically take a broad index for stocks and bonds and then find a market equivalent or some type of equivalent for the private equity sleeve to try to balance it. The key is the department is saying, don't just take, and I know sometimes people when they use software will automatically say S&P 500. The department's saying you can add more value to that, and it's important to really drill down. Plan fiduciaries need that, but so can others in this process. So as you do benchmarking, there is a lot to be done here in terms of the process, and I'm sure we will have comments about benchmarking, but this is one that actually allows those with the expertise to shine in this process, and I think that can be a really, really good one, because as you look forward, there's the benchmarking will play a huge role in litigation. Remember we started with litigation today? It'll play a huge role in litigation because it's about who has the burden of proof. And Kevin, you and I can go on, but we promise not to do that with the deference webinar that nobody wants to hear. So I thought I'd hit that for 2 seconds, but I figure you may have something, and maybe you just close us out with complexity as the final thing. So as we finish our time.
Yeah. So the last element is complexity, and this is essentially the department saying that as a prudent fiduciary, you're supposed to understand the investment you invest in. And it gives an example of a product where a plan fiduciary, with the help of a 321 advisor, evaluates a product that has, carried interest, performance fees, and clawbacks. And, the department says, they understand this, they understand how this aligns incentives, and that it can be prudent to incorporate complex products so long as, the fiduciary understands why they're including it and how it may be beneficial to the plan. So, those are the 6 elements. And, the key here is that the department isn't saying, if you check boxes, if you tick boxes, if you invest in certain things, you won't get sued. Instead, what DOL has done through this proposal is they've outlined really the 6 key things for thinking about plan investments in general. And then they've provided some suggestions about fact patterns that they think may come up from time to time and how they would look at them. So, this is not a prescriptive rule. It's a framework for investment decision making, whether it's an alt, whether it's a passive, whether it's an active. And so, we would expect that there's going to be comments coming in on behalf of managers of all kinds, as well as, the consultants and advisors who help select them.
Mm-hmm. So as we wrap up, we just want to say thank you for joining us. We appreciate the questions. We've tried to weave them in. And John, we will hand it back to you to close us out.
No, thanks, David and Kevin. Again, thanks for presenting today, and thanks everybody for joining us. I'll speak to you all soon. Thanks again. Bye.